Howdy, Jacob here. Today we're looking at Ciena Corporation in the communications equipment industry. 7.2 billion market cap on 7.5 billion enterprise value. Founded in 1992, they provide hardware, software services for delivery of video, data, and voice traffic metro. Okay, growth is pretty reasonable, very solid, mid-single digits, upper single digits over the last 10 years, revenue growth year over year, 2.3 billion in 2014 to 4.4 billion in 2023. Operating margin up a little bit from 10 years ago, fairly consistent in the low 40s. That's gross margin. I don't know if I said that. Operating margin up a bit in the upper single digits. Return on invested capital averaging mid to upper single digits, so not too impressive there. Balance sheet has 1.1 billion cash-like products, 1.5 billion long-term debt. So not a whole lot of debt in relation to cash on hand, and 2 years in a row of not great free cash flow, but outside of that, 400 million in free cash flow. So definitely no concern with that balance sheet. Use of free cash flow is a little bit of reinvestments, a bit on acquisition, and then a lot of share repurchases. So let's just get right to it. On the revenue growth side, if we think they can keep their past revenue going, which I think seems fairly reasonable to me, given a little bit of reinvestment and acquisitions, I think 6% should do more than fine. Market average PE, price to free cash flow, based on growth as well as return on invested capital, as mediocre as it is. Margins, let's do a little bit of a range of 6 to 7. And then for share repurchases, 1% is about 70 million. 140, 280 to offset stock-based compensation. 280 is about 60% of these years' free cash flow. I think that's a little too much for me. And let's do minus 1%. So that would be about 200 to offset stock-based compensation and 1%. 200 million I feel more comfortable with, so that's about 50%. So here, with my assumptions, I'm assuming about half the money goes towards reinvestments and acquisitions, half the capital allocation and free cash flow goes towards share repurchases, and even with these assumptions, we're saying the stock price needs to fall 67% before you get the return we're looking for here. I think if they can get those double-digit margins back, they might be able to do some good damage here. But for me right now, I think I'll probably just be hesitant and wait a little longer for those type of things to show up more. But I do hope you enjoy the video and have a great rest of your day. Thank you.